Hi, everybody. Welcome back to the Fourth Revolution Quarantine Edition. And today I'll be talking about what in the world happened in the markets yesterday with the fourth largest drop-off in this very volatile market season. I'm also going to talk about some of the decisions I've been making and some of the investment strategies I've been looking at throughout this uncertain time. So here's a candlestick chart of S&P 500. You can see we've just ripped up since our bottom on March 23rd, and we were getting to very, very frothy levels. Earlier this week, we flipped positive for the S&P 500, and I think this pullback that we've had the last couple of days, and especially yesterday, is justified. We've been hitting these frothy levels because of all these retail investors jumping into speculated stocks and not really having much thought around it. Here's a little stock chart that I thought was interesting. So this is the number of Robinhood users. Robinhood is a trading account that typically is associated with younger, newer investors. And this is Hertz, the number of Hertz shares that Robinhood users own. And here's the bankruptcy right here. And you can see after the bankruptcy that they just skyrocketed as Robinhood users saw ostensible value in Hertz shares, but it was pure speculation. And they actually moved the stock up. But I mean, there's no value in a bankrupt stock. You know what I mean? It's just unprecedented how much speculation is happening. It's not just Hertz. It's J.C. Penney and a number of other quote unquote value investments that these new retail investors are speculating on. And so yesterday we kind of blew a little bit of the froth, so to speak, off the top. You could see with both of these oscillators that we were quite overbought, and this was justified. So we came back down to this 200-day moving average, as you can see here, and we bounced off of it today. I'm not going to say that this pullback is over, but we are pausing. And this 3,000 level, which is represented the 200-day moving average, is a solid support level for at least today. I don't think we're going to blow through it. Next week's a different story. People are looking for more news on if there's going to be a second wave of this virus, and wondering if there's going to be more monetary stimulus. So the Fed spoke earlier this week, and they discussed, how they're going to hold rates at 0 to a quarter percentage of the Fed funds rate for the next 3 years, as far as they can see. But Jerome Powell, in his speech, did not have a very optimistic outlook. He was a little bit bleak in his verbiage, and he was saying that maybe the equity markets need to rethink some of their risk to reward value. And I think that's what really led to this drop off that we saw yesterday. So here's a chart of the VIX, the volatility fear index. We hit our highest point since early April, just to show how much fear is in the market and how much we drove up yesterday. Obviously today we're coming off of this high we saw. But so as far as what I'm doing, yesterday I had some puts. I bought these puts right around the first week of June, so last week, and I held them up until yesterday. I sold out of them maybe a little bit too early, but I was able to cover some of my losses, and I actually bought QQQ at the end of the day at close, and I was able to make a hefty profit on open today, because the reason I bought QQQ is driven by the NASDAQ 100, which is the biggest tech stocks in the world, or in the U.S. specifically. And as the Fed cuts rates in the long term, these growth stocks are able to be discounted at a lower rate, and their long-term earnings guidance is able to be brought back at a larger value. So tech stocks are actually more valuable because of this extended low interest rate environment that the Fed has given us. So that's one move I made. I also bought RTX, Raytheon Technology, as they came down to their 50-day moving average. I think this is a good buy. This is a hedge on the Boeing situation. I think Boeing might be have a good upside to it as the consumer aerospace business comes back. Obviously, there's a lot of risk associated with Boeing, and Raytheon is a hedged version of that risk because they still do have a large number of government contracts, which is going to kind of solidify some of its long-term revenues, but like I said, also give you some of the upside exposure that you want to the aerospace consumer market. So once again, I'm not super bullish in the market right now. I think that there could be a larger pullback. We're still pretty frothy at our current levels, but don't be over bearish. Don't be buying huge amounts of puts. I've sold out of my puts. I'm waiting for a pullback past the 3,000 level. That's what S&P right now is using as a support. So look for S&P to drop below that for a broader market pull down. So I'm only holding about 10% cash right now for that. I've put a lot in the markets on the way up, and I'm waiting for one more downward wave to put the rest in. But if there is another wave of COVID cases, you definitely could see a larger pullback, especially if it was just as bad as the first one. So look for that. And thank you for watching the Fourth Revolution. I look forward to seeing you guys next time. And don't forget to check out Zacks.com/promo for our latest promotion. Thank you.